as the Nigerian economy experiences a gradual recovery from recession following an increase in oil price and output this year, the country's external reserves has continued to decline. External reserves declined from $36.3 billion as of January 29, 2020 to $35.09 billion as of March 1st, 2021, losing about $1.4 billion in just a month. According to the CBN Governor, Mr. Godwin Emefiele, the decline in the country's foreign exchange earnings and subsequent adjustments in the value of the naira vis-a-vis the US dollar has continued to show the CBN's support to improve production of items that can be produced in the country and further conserve the external reserves. Despite the increase in economic activities globally and rollout of COVID-19 vaccines, the external reserves declined due to lower foreign exchange receipts and sustained interventions to stabilize the exchange rates. With the rapid drop in the country's external reserves and the scarcity of dollar, the big question is, what are the potential effects of this on the economy and businesses who, of course, rely on Forex? Well, I won't be doing this alone. I have joining me now via Skype. He's an investment research analyst at United Capital PLC, Mr. Ayomide Akinloye. Thank you very much for your time, Mr. Akinloye.
Thank you very much for having me, Tolu. Nice, great to be here again.
Yes, it's been a while. Oh, yeah. Looking at the figures I reeled out before getting to this point, the country's external reserve is dropping despite increase in Brent crude, which should be a welcome development for us in this part of the world. What do you think? What can this be attributed to?
Okay. Yes, the external reserves actually over the past 1 month, I think, is down about 1.4 billion US dollars, and largely, definitely, the factors are not far-fetched. One, yeah, truly, all prices have been recovering significantly. I mean, at some point, Brent was about $67 per barrel. But the dynamics of the oil market is that the oil market is a futures market. So the prices that we see today, all Brent at $67, $65, $64 per barrel today, does not imply that the FX inflow would be coming in, within this same time period. So the oil market is a futures market, and the gains you are seeing in oil prices at this point in time would expect to accrete in terms of increasing the external reserves in, say, 3 to 6 months' time, because it's a futures market. So the FX inflows that we are seeing from oil proceeds at this point in time are from oil contracts and deals that have been signed off about 3 months ago, when crude oil prices were still about $40–50 per barrel. So that is why we are not yet seeing the significant impact of the recent rally in oil prices on external reserves. Then we also look at the fact that we had an Eurobond maturity within the first quarter of the year, about $500 million, and also the FX to take care of that definitely would come from the CBN. So about $500 million was used to pay off maturing Eurobond obligations also during that period. And lastly, the CBN still continues to intervene in some key segments of the market, although yes, the CBN has not been fully active, but we've seen the CBN continue to intervene at the retail end of the market, at the SMIs window, with interventions usually around about $100 million US dollars, typically. So all those interventions, coupled with the Eurobond maturity, drained the external reserve significantly over the past month. But for the oil price improvements, that will begin to accrue, the external reserves begin to benefit from that rally, in 3 to 6 months' time, due to the, futures nature of the oil market.
There's been a lot of comments, from all quarters with regards to the central bank's forex policy and how it's being managed. Talking about the INE window, we have the parallel market, we have rates for importation of petroleum products. We're a country with many rates. What do you think about this? What's your assessment of the entire forex policy that we run? I know we've talked about this before, but let's be very critical of it now. What do you think of this?
Okay, clearly it's inefficient to have multiple exchange rates in any economy. And this is one thing that deters foreign investors, but when they know that, particularly for long-term investors who want to do business with a long-term perspective in Nigeria, it becomes an issue to clarify at what exchange rates are you going to be dealing we have the I and E window rates like you mentioned, we have the parallel market rates, we have maybe the BDC rates, we have rates for importing different items and all. So we have the customs rates for you to be able to pay duties on importation and exports and on imports and exports basically. So all these multiple exchange rates that we have definitely does not augur well in terms of perception of the economy to investors basically. But it's largely a byproduct of the fact that we have huge demand for FX and very limited supply. The CBN's ability to supply FX or to supply USD to the markets is largely capped by whatever happens in the crude oil market. So whenever we see the crude oil market go southwards, there's a ripple effect which basically discourages foreign portfolio investors, which is another key source of FX inflows for the CBN. So once oil prices decline, production is affected like we have now, like we had in 2015, 2016. If that happens, then foreign investors are discouraged from bringing in FX because they are uncertain on how they will to come out of the country when they need to come out. Like, we had in 2020 where many foreign investors were stuck into the country and they have to seek alternative means to move out funds. So all these factors, the fact that we have that limited supply and a very huge demand base would always raise the need to have multiple exchange rates, multiple windows for people to meet their FX demands basically. So it's definitely a byproduct of that. And resolving the issues beyond just some set of policies. It's about the balance on which the economy sits on. Like I mentioned earlier, the limited supply that we have is because we are dependent on one or maybe two major sources, of which one source is dependent on the other. Once oil prices and production becomes very weak, then foreign investors don't bring in FX into the country. They are not interested in buying our bonds. They are not interested in buying our automobiles, our instruments. Basically, they are not interested in investing in the capital markets. So there's a need to shore up the base for supply for FX into the markets basically, and that will require diversifying that base. For example, taking advantage of our mining potentials, taking advantage of our agricultural potentials, where we can export some of these commodities and in more FX. Trying to produce as much as possible, some of the things that we import. If we look at our imports, the trade statistics, apart from petroleum products that we import, which is usually the number one item. Another category of items that we import a lot is, in agriculture, in food, which, we can actually produce some of these things locally. So if we are able to implement, for example, we have the Dangote refinery where, our PMS is being produced locally, and then we are also able to produce some of these agricultural products locally. Those top two items, reduces the pressure on FX demand from the demand side of things. And, once we have that, having more FX basically would give the CBN the ability to converge all these rates into one window and actively manage the markets.
I don't want to put you on the spot, but I want to ask you, do you think the naira is appropriately priced at the moment? Many think we still need to devalue the currency.
Well, so basically, if we look at market fundamentals, basically, recently the CBN did a devaluation, or say an adjustment to the I and E window rates, where we now have the I and E window rate at about 410 naira to a dollar. And for us basically, we expected that the naira would find some base at about 420 naira to the US dollar, basically, in terms of having that sort of convergence. By the time the the rally in crude oil prices begins to accrete into the external reserves, and begin to see external reserves, sort of build up to the 37, 38, $40 billion level, which will give the CBN adequate, buffer to be able to intervene more than it's currently doing in the FX markets. It would bring to be able to bring in some of the demands that we have in the parallel markets, and that demand will come to the I&E window and allow the rates to converge, similar to what we had in 2018, where the parallel market rates and the I&E window rates, converged, and then they were sort of trading at within similar bands. So what we see is, we still expect to see the naira, be devalued further, basically to the 420, 430 naira to a dollar level, and that would be where most likely exchange rates will find support and convergence across most of the markets.
Now, would you think that Nigeria is overestimating the power of crude oil to keep the country running?
Okay, so definitely there's an over-reliance on crude oil.
Proceeds from crude oil.
Okay, there's an over-reliance on proceeds from crude oil, basically, in terms of to run the economy. Yeah. When we look at the size of the economy, for example, the last GDP reports, crude oil, the oil sector now contributes basically less than about 8% or 9% of the overall economy, basically less than 10% of the aggregate economy, and the remaining 90% are basically non-oil. So, despite that, whatever goes on in that 9 to 10% segment of the economy is very critical to the remaining 90%, and that is because the other 90% don't have the necessary fundamentals in place and the necessary system in place for them to run appropriately without having to depend on the other 9-10% segment of the economy, which is the oil sector. So, like I mentioned earlier, there's a need, because, for example, the federal government is very much reliant on proceeds from crude oil in terms of revenue. From an FX perspective, which is very critical for a nation like Nigeria, considering the fact that we import and we do a lot of imported consumption. FX is very critical, when it comes to cost of living, when it comes to price of commodities, when it comes to our inflation rates, and across board like that. So the FX is very important, and that is a variable, an economic variable that is largely dependent on one singular thing, oil proceeds. So there is an over-reliance definitely on the oil sector, and that over-reliance needs to be broken, and that is where the recurring theme of diversification of the economy comes to play. There's a need, when we are saying diversifying the economy, is not just a rhetoric that is just out there to be put out there, but basically from an FX inflow perspective, there's a need to diversify that base. There's a need to reduce reliance on oil and foreign investors to bring in money. There's a need to create an enabling atmosphere for sectors like agriculture to thrive, for sectors like mining to thrive. We have some of the largest deposits of iron ore, of some of these very precious metal and materials in Nigeria. There's a need to allow the agriculture sector to thrive also, and these are key sectors that could give us an avenue for us to be able to export and earn more FX and earn more forex, basically, and that would definitely go a long way to reduce over-reliance on crude oil from an FX perspective. From a government revenue perspective, by the time if the mining sector is kicking into full gear, royalties, taxes, these are all key sources of revenues that will come. Employment opportunities to be created, personal income tax, also becomes another way, VAT also becomes another thing. So all these things are key. These are key, definitely. These are key revenue sources that could end up coming out from aligning these two key sectors to thrive. And all that will be done by creating enabling policies that would encourage investors who have the money, because the federal government does not have the money to drive any transformation that needs to happen in these sectors. It's private investors, private businesses, who have this access to raise this kind of capital from the capital markets, from the international markets, that can do this, that can, embark on such ambitious projects. But the responsibility of the government in this case would be to create an enabling environment from a policy perspective to enable these investors, consider those industries or those sectors attractive. Otherwise, that over reliance and that overestimation of the power of crude oil for as an important variable for Nigeria, will always continue to be there.
Almost finally, dollar shortages we've identified in our discussion seems to be increasing, I beg your pardon, as prices of imported commodities, as it were. Now, we've seen interventions by the central bank to try to improve or support made in Nigeria products and improve exports. How would you assess the impact of all of these moves? We've seen in the agricultural space, we spoke earlier about that. We've seen in the textile space, we've seen in the pharmaceutical space. All of this is to promote in-country production and reduce our dependence on Forex. What do you make of this? What's intervention? How well would you assess it?
Okay, yeah, so basically, the CBN definitely has put a lot of efforts in terms of making funds, intervention funds available, particularly under its development finance programs. It has made so many funds, intervention funds available for so many sectors. In the agriculture sector, we know the Anchors Bora program, which is a very popular one. In the pharmaceutical space, intervention, at the start of the COVID crisis, and so many other small, medium-scale business, funds that have been made available for businesses to take advantage of. But these strategies have been fiat-led strategies. That is basically pumping money into these sectors without the environment being conducive for them to grow. So that is the main thing. That's the key issue, preventing some of these intervention funds from, delivering any tangible success. Now, when we look at the agricultural space, look at manufacturing, look at textile, we look at all these key industries. The first thing is, who are the people getting access to these funds, and how are they able to use these funds to, drive the transformation needed in the sector? Number two, is the environment conducive from a policy perspective, from the government side of things in terms of regulation? Is the environment conducive enough for them to be able to grow? Still speaking to the environment, quite linked to the environment. When you look at the consumers, what is the health of the average Nigerian consumer today? The truth is, Nigerian consumers are growing poorer by the day, and the bottom of the pyramid, segment of the population is gradually increasing by the day. So it becomes obvious that even as much as we are trying to drive production, there are not rich enough people to afford some of these products, and it means that the production or any attempts to drive any increase in productivity, amounts to a waste. Because if you're investing in a sector that is unable to sell its produce, then there is no point, embarking on all those investments. So there's a need to create consistent policy framework that will allow all these industries to thrive, because it's beyond. Yes, the investment is a critical thing, but investing in a sector that does not have that enabling environment to thrive, that does not have a market to sell to, is just not worth investing in. So there's a need to get those fundamentals right, and even the CBN would not need to have to take up the role of intervening and giving all these intervention funds. Once all these key fundamentals are present, private businesses, private individuals will take up the mantle of supplying the capital needed. In fact, one of the things that we can see as a deficiency is that once it's the CBN that is driving the investment bit of some of these key sectors, then it's obvious that there's a reason why it's the CBN. If private individuals are not the ones pushing this, if private businesses are not the ones making these key investments, it means it's because they don't see opportunities. They don't see opportunities for them to recover their investments. So when we begin to see private individuals play, actively take more risk with their capital in some of these sectors, then we can now speak to the fact that yes, these sectors are becoming more and more attractive. So we need to get the policy framework right. We need to get the business environment right. We need to enable and strengthen the consumer base to be able to earn more. which comes from, wage growth, which comes from creating employment opportunities, and all these things are, more or less interlinked or intertwined, basically. So there's a need to do that, and then the investment will come naturally, and even the CBN would not have to. But judging from all the investments the CBN has been doing and looking at the numbers, we are still heavily reliant on importation of food items. We are still heavily reliant on importation of textile materials. So clearly, some of these things are not giving the necessary results, and some of the things I've mentioned are the key reasons why.
Mr. Akinloye, on a final note, and let's do this in less than 2 minutes. I'm looking at Thursday's figures from the floor of the Nigerian Stock Exchange, and the market is down 0.40%. We've seen this negative trend for some time. Top gainers for today, we have University Press PLC, Morrison Industries PLC, KP PLC, Transcorp, WAPCO, Lafarge Africa, and top losers we have Fitsin Healthcare, NNFM, NMLware PLC, NEM Insurance, NCR. I just want your views, your overview on the market performance. It's been negative for some time. What is playing out? What do you make of this?
Okay, clearly two things quickly. We've seen yields in the fixed income markets, begin to reverse. So we're seeing higher yields in the fixed income market, and that implies two things. Number one, investors now have the opportunity to reduce their risk exposure to equities and basically take up riskless positions, or less risky positions in bonds and fixed income instruments, because yields are becoming more attractive. So as a result, we are seeing investors sell off equity positions. Number two, higher yields also implies higher cost of equity for valuation purposes for most of these companies. So there's that sort of concern that valuations may be stretched for some of the key sectors, particularly in the cement sector and the telecom sector. So we are seeing investors beginning to book profits largely on some of those stocks, and we think that the bearish reversal that we are seeing in the market may still continue until there is some sort of stability in the fixed income markets, particularly when you get to their peak. So those are the two key things that have been driving the negative sentiments we've seen in the equities market, since February. The yield environment is reversing back to where it was before the record level crash that we saw last year, and that is driving the negative sentiments towards risky instruments, basically equities in the Nigerian market. So, and we think it will still be prolonged until we see some stability in the fixed income market.
Investment Research Analyst, United Capital PLC, Mr. Ayorinde Akinloye. I thank you very much for your time. I really appreciate this.
Thank you very much for having me.